Hey, this video is going to teach you what you can do to acquire 10 properties in the next 10 years with very little money. Hey, I am Mr. Maciek. Welcome to the channel where I teach people all about being a real estate agent, investing in real estate, and in general, just other investment instruments that you can do. Hey, YouTube Analytics is telling me that over the last 28 days, out of every video that I have, 72.2% of you are not subscribed. So please subscribe below. Now, if you're watching this video, you probably want to know, how do you get into real estate investing with as little money as possible? So this way right here that I'm going to discuss is a really good way, and this is actually how I got started. So a real quick question of the day, do you already own real estate property? Please let me know in the comments below, and if you don't, tell me, why do you want to own some real estate investments? Okay, so we're going to go over 4 different things that you need to pay attention to when it comes to getting started with real estate investing for as little money as possible. Now let's get into it. Okay, the main idea of this plan is as follows. You buy a home as your primary residence. You live there for a minimum of 12 months. And then after 12 months, you buy another home and you turn that first home into a rental. But as easy as that sounds, there's a lot more to it. It's really important for you to know a few things. So here's number 1. 3% down. Now you probably already know this. You can go get a loan out there, a conventional loan, with as little as 3% down payment, which is excellent because this whole point of this video is how to get into real estate investing with as little money down. And this is the way to do it with as little money down. So save 3% of the purchase price. You're looking at $200,000 properties, you need $6,000. Credits by sellers can really pay for almost all of your closing costs, if not all of them. So if you don't have a 3% down payment right now, just go out there, make some side hustles happen, and really start saving that money. If you think you want to go the FHA route, which is 3.5% down, it's actually a pretty decent route, but if at all possible, try to not do it that way. Try to go with the conventional loan. If you're thinking about going the FHA route, which is actually 3.5% down, then know that it's actually a higher risk. Plus there's higher expenses, much higher expenses, especially on the front end of buying the home. So if you can, try to go the conventional loan route. You need just 3%. Some loan programs are 5%. Which brings me to point number 2, your DTI, your debt to income ratio. Now, I know you want to get into real estate and you didn't think doing any math has anything to do with this, and I guess someone else can do the math for you. But you need to really be aware of your debt to income ratio. So let's just go over what this means. In a nutshell, your debt to income ratio is what is your debt as shown on your credit report. So any kind of car loan, any kind of payments for school loans, or any credit card debt and revolving credit and so on, compared to your income, what you're actually able to show on pay stubs. Now, if you have 4 side hustles, all paying cash, not the same thing. You really need to go talk to a lender to get clarity on how you need to structure your income in order to qualify for loans. So here's my first warning sign. Beware of lenders. Here's what they're going to do. They're out there to make a sale, to get you a loan, because without that, they don't get paid, right? So they're going to go and say, great, Mr. or Mrs. whatever, you are qualified to buy a home for $300,000. And all of a sudden you're like, oh, wow, nice. I was looking at $200,000 homes, which were kind of crappy neighborhood. And now I'm qualified for this much nicer neighborhood, which I'll be proud to live in. That is a warning for you. Do not go that route, please. What you really want to do is talk to the lender about, wait a minute, I want to qualify with a particular debt to income ratio because I have a long-term plan of investing in real estate. Okay, so if your plan is just to have a nice house and live there and not invest in real estate, great, go with their plan, right? Go with whatever they qualify you for. If they say you're qualified for $300,000 and that's the maximum, great. You're qualified for $300,000 and go buy a house for $300,000. But if you want to invest in real estate, don't go that route. Go the other route. And I can't really give you a particular number of your debt to income ratio. Now, on a conventional loan for a regular home, it's maximum 50%. FHA is actually 60% or 59.9 or something like that. But on an investment property, it's going to be a little bit different, right? Because even though you're going to live in it for the first 12 months, the goal eventually is to be an investment property. And there's no magic number. But what you want to do is keep it as low as possible. So if you can get it in the 30s or even in the 20s, your debt to income ratio after you've bought this, then that is a great way to start. And that leads me to point 3, and it's actually your future debt to income ratio when it does become a rental. This is probably the most important part of this video right here. So please take notes, listen up, research more. You really want to know about this. So here's the deal. Let's just say, for example, that you are buying a home for $200,000 when you're approved for $300,000. Great job making that decision. Now, how much is this home going to rent for? And there's a formula you have to use, which is 0.75 times the monthly rental rate. Okay, so let's just say this home rents for $1,000, and do the formula, 0.75 times $1,000, that's $750 per month. And ask yourself this very simple question. At $750 per month, is that higher or is it lower than your PITI? And what is PITI? Principal, interest, taxes, and insurance. Add those up. That's basically your monthly payment. Now, if you're only putting 5% down, you also have mortgage insurance, PMI, private mortgage insurance. So add that fifth little element. If you're putting 20% down or more, you're good. You won't have any PMI. So add up your PITI plus your PMI, and if that number is higher than the 750, then the 75% of the rental income, then you're in trouble. That is not the way you want to go. This is not how to build 10 properties 10 years in a row. So let me quickly explain why. So going back to the second point, which is about your DTI, your debt to income ratio, let's just say that you are going to purchase house number 2 now. Well, they look at your current expenses as stated on your credit report and your current income that you are reporting with your W-2s and so on. And then they add this second source of income, which is your rental income. And they assume the worst. They assume you have a 25% vacancy rate. If you have a 25% vacancy rate, get out of being a landlord because you're not very good at it. Either that or go get yourself some education and learn how to be a better landlord. But here's the real magic. If you're able to get your 0.75 times rental rate to be lower than your PITI plus PMI, then you're actually winning, because what's happening is you now have a surplus on the rental. That's not even a rental yet, it's still your primary residence, but you have a surplus on the theoretical rental, and they add that money towards your monthly income. So now you have a second monthly income that doesn't even exist yet, but you're able to qualify for a better loan. And if you start your real estate investment portfolio with really good ratios of PITI to your rental income, then it's going to be easier in the future to qualify for loans. In fact, you're going to start getting better interest rates, and you might be able to go qualify for a duplex, triplex, or something even bigger and better. Okay, I know that part was a little confusing, so please drop a comment and just ask me, just pause this right now and ask me a question, because if you don't get it fully, this is the most important part. If you don't get it, I'll explain it. I'll make a whole video. I'll make a 2-hour tutorial if that's what you want. Just let me know in the comments. Okay, the last part that is very important when it comes to starting a rental portfolio with as little money as possible is about what we call war zones or Class D properties. Now, if you're gonna go start this way, which is actually what I did, I made a lot of mistakes in my real estate investing, which is why I wanna teach here on YouTube. So if you go with that route of going for the really low income properties, because that's all you qualify for, let me tell you a few things. You're going to have a disproportionate amount of phone calls, of late rent, of evictions, of damages, of theft of large items such as air conditioning units and hot water heaters and appliances and even front doors. Yes, I've had a front door stolen. And even though the numbers look really good up front, that you're gonna make this, great double-digit return, in the long run, that's not how it works. I actually got rid of almost all my Class D properties. I got one left actually, and that one just has an excellent tenant that really cares for the property. Not to say that this isn't a good business model. It is a good business model. It just depends, do you wanna be a full-time landlord? Do you wanna have a lot of problems? Do you wanna have a lot of phone calls? Do you wanna repair everything yourself because you don't have the budget for it? All right, if you think you're getting some value here, please like this video. I would really appreciate that. And now, if you're gonna get into real estate investing, it's very important for you to have a great credit score. Click this link, watch this video. It's all about how to improve your credit, all the little things you can do. It's a little lengthy video, but you're gonna learn quite a bit from it. So please click it, watch it, execute. Thanks for watching.